announced. Let's go now to our regular valuation expert, Roger Montgomery of the Montgomery Fund. I've commissioned him to assess the real value or the intrinsic value of BHP, and we also want to look at banks with the yield stocks going so high. Are they still worth buying? Roger, thanks for joining us.
Thanks, Peter. I'm glad I don't have your job.
Yeah,
that's hard. What you've just done is not easy.
Yeah,
People
thanks,
need to
mate.
understand that.
No, I compliment you, you compliment me. We're a mutual recognition society.
Right,
all right, mate.
very good.
Yeah, I know you don't use your due resources, but this week I said, well, the price is going down and lots of people like BHP. Some people would have bought at higher prices than thinking about dollar cost averaging down.
Yes.
So I said to you, give us an idea of what you think the company's worth.
Well, our good friend Ross Greenwood, he often tells me that he's got a great strategy. Whenever BHP falls 10%, he buys more of it.
Yeah.
And he's done very well over the years.
Yeah.
Now, I think that kind of strategy works in a rising market. So, in fact, it'd be better if you just bought it all at the start, of course. But
like the $2 price when you weren't even born.
Now, let's put this in context. BHP is the most inherited stock because the baby boomers have got it from their parents. And it's one of the few surviving stocks from when their parents were around.
Yeah.
So it's the most inherited stock. So BHP is of interest to a lot of people. The problem with BHP is that we tend as investors to think the recent past is forever going to continue into the future. And between 2004 and 2011, the price of iron ore in that 7-year period, the price of iron ore went from $20 a metric tonne to $187 a tonne. For the 30 years prior to 2004, it traded between $10 and $20 a tonne. So we all believe, or many investors believe, that $100, $130, $80, $90, that's the price of iron ore. That's what it's going to be.
It's the modern era average price.
Yeah, correct. Now, I'm not sure that that's right.
But that's one of the reasons why you play it, because you can't work out what commodity prices are going to do, so it's unreliable for your valuation method.
So what we do is that's one way of looking at it. Well, what we do is we ask ourselves questions about how certain we are about the competitive landscape and the prospects of a company a few years out, 3, 4 or 5 years out. Now, when we go out that far, what we think we know is that there's a very large supply response in iron ore coming, and that will happen next year and the year after. And the result of that has to be lower prices unless China re-emerges with stronger demand than what it had before. But what we can see happening, if you believe Chinese results and Chinese GDP numbers, is their GDP is slowing now. Their investment in capital expenditure is slowing as well. They're not building as many roads that no one's driving on. They're not building as many schools that no one's attending. They're not building as many shopping centres in cities that no one lives in. And so that means that the composition of economic growth for China, it may still grow strongly, but the composition of that growth is going to change. So instead of them demanding as much iron ore as they have recently, 2004 to 2007, the price went from $20 to $187. It'll be a different composition of growth. And they've said openly that they're looking for growth that is more consumer-led. Yeah. So if that happens, then demand for iron ore will not grow as fast. Now, be careful about this. I'm not saying it's going to drop. I'm saying it won't be growing as fast as it has before. But it's that strong growth that supported the price of iron ore. Now, a big part of BHP's return on equity is driven by the price of iron ore that it can sell. And if that iron ore price drops, and we think it will, we could be wrong, but we think it will, then the ROE for BHP will drop also, and its intrinsic value will fall. And that's what we're concerned about. So there were some of our peers, for example, had intrinsic values last year of $55 for BHP when it was trading at $40 or $44. And our valuation at the time was about 32. It's now at 32, and our valuation's probably closer to 27 or 28. But even at that point, even if it got to that point, Peter, we would need a big discount to that level to give us some comfort, a big margin of safety.
But Roger, could it not be that the actual market price is already factoring the bad news that you define quite adequately, and that bad news may well be worse than it really is going to be? Like, for example,
it might not turn out as bad as everyone thinks.
Because they're investing in potash now, and potash is going to be a good product, and they are diversified. So what I'm saying to you, is it a much harder company for you to wave your magical intrinsic valuations on?
No, it's not. We just press a button and we get the intrinsic
But your
value.
assumptions have to be, they're critically important too, aren't they?
The things that change that determine the intrinsic value, the big things that change are things like the reinvestment rate. What proportion of their earnings can they retain and employ at a high rate of return on equity?
Yeah.
If we kept the reinvestment rate constant, for example, what implications would that have for intrinsic value? If we kept the payout ratio constant, what impact will that have on intrinsic value? And you're right, we're less certain about the prospects for BHP than we are for the banks,
Or
we are
David
for,
Jones or someone like
or
that.
Flight Centre, for example, that just had an upgrade today and it's one of our bigger positions, or the Reject Shop. We're much more certain about those things, so we can do very, very well for our clients even though we don't own BHP. And it's been, by the way, it's been very handy not owning BHP over the last year.
But how low, so you said you
So
value...
$27.
Yeah, it was about the figure, you think
I would
now?
start to feel comfortable if it was trading in the teens. From 27.
yeah.
Now, hang on a sec. Now, let me just...
Yeah, I
and
don't think it's
viewers,
gonna
you
happen.
need to see Peter's reaction to this.
It's not going to happen.
It's not going to happen. I was told exactly the same thing last year on Newcrest.
Newcrest, yep. I know
Newcrest.
that. I wrote it up in an article. But it's not, BHP is a different beast than Newcrest.
Okay, then. That's what people tell me.
Yeah.
And in a couple of years' time, we'll have a look at it again. And
Okay,
we'll decide.
good. Fantastic.
All right. So
All right.
now the banks.
Banks.
Okay. So the issue with the banks, ANZ's results came out just yesterday, the day before. And what we know is their revenue is flat. Okay. So what's happening in the banks is there's no credit growth. Now you only need to retain capital if you're going to grow credit. If you're going to lend that money out, you retain your capital, you lever up that capital, and then you supply credit growth, right? That's what you're doing. There is no credit growth at the moment. That's the problem. And the banks have had no credit growth or very little credit growth for some time. The issue, of course, is that the right response is if you can't deploy that capital at high rates of return, pay it back to shareholders. And so ANZ has flagged that their payout ratio is going to go up. Okay, that's a good thing, and that's what's driving the share price
Yeah,
up.
it's one of the propositions you make.
However,
If you can't use the capital effectively, give it back to the owners. Yeah.
But if you've got this glass here, Peter, right, that's generating 20% a year every year, and you've got that glass over there that's generating 20% every year, and this one's retaining all the profits and compounding at 20%, and that one's paying it all out, this one's worth more.
Oh, of course. You want ones to keep generating profits.
So as banks increase their payout ratios, all things being equal, their intrinsic value goes lower, not higher. But the share price has gone up. So what we now need to see to justify these valuations, what we now need to see is we need to see credit growth. And if that doesn't transpire, then the banks are unjustifiably expensive. Now, interestingly, in the papers today, everyone was talking, a lot of articles were talking about a bubble in the banks. I'm not saying there's a bubble. I'm not saying they're going to crash. They do appear to be expensive. And one of the things that always scares me is in the newspaper, in the Financial Review the other day, I'll quote from the paper, the usual valuation methods the conventional methods used to value banks no longer apply. Now, when was the last time... You would have hated reading
that, wouldn't you? You can't believe that kind of crap.
When was the last time... No, I don't think that's true, but when was the last time that you heard somebody say the old valuation metrics no longer apply? Think 2000, 1999, some stocks that listed that had no profits.
.com era.
Right, okay, so if people start to believe that the old ways of valuing businesses don't apply anymore, be careful.
Yeah, it just seems to me, look, a lot of people made mistakes pre-GFC, and now they're just chasing companies that pay dividends. And the smart people bought them a year or two ago.
Correct.
And now people are risking. They're thinking, 5% from a bank grosses up to 7% if I'm a retiree, term deposits to 4.5%, therefore I'll try. But there's more risk.
The yield play, this yield chase that's going on is a fad like any other fad.
But it's a better fad than chasing .com companies.
Oh, absolutely. Well, although .com's on the first day, I think on the NASDAQ on the first day of listing in 1999, the average first day profit for an IPO was 90%. So that wasn't a bad one either.
But not enough people sold out on that day.
No, you had to sell out on the first day. But the issue is that if you're coming to the party now, you should have your eyes wide open because this party's been going for a while, and there aren't enough taxis waiting at the outside the party to take everyone home to safety. So be very, very careful at this point.
Yeah, I think if you're a person who's buying now, you're going to have to be happy with maybe a 5% yield on the price that you paid. That might gross up to 7%, but your capital could actually fall.
And if you're expecting growth, if you're expecting capital growth, you really need that credit growth to emerge, and that's not happening.
And in a sense, we need a stronger growing economy.
Oh, absolutely.
And we have a pretty slow growing economy now.
We do, and if my thesis on iron ore prices and China ends up transpiring the way I've been talking about on your program now for a couple of years, then we may not get that growth. So we just need to be careful. We need to watch the iron ore price. We need to watch what's going on in China because their capital inflows is helping support our economy and our balance of payments.
Yep. Okay. So go through the 4 banks. Are they all in the same category?
Okay. The most expensive at the moment, I believe, is the Commonwealth Bank, but it's also the best performing bank. Okay, there's no doubt about that. I think the bank with the best prospects, but is also expensive, is the ANZ. I think Westpac. Well, I actually think that they may just get the Asia story right.
I think so too.
Okay, I think so. And they look relatively cheap to the other banks, but they're not absolutely cheap. They're not below our intrinsic values. They're above. But they're relatively cheap compared to the others. The NAB is the worst performing bank in terms of its economic performance, but that could start to turn around. They could start to get their strategy right, and it's a legacy issue. It's around paying too much for assets in the UK. They've had no intrinsic growth for a decade, so you could argue, well, now if they get their strategy right, they will see some intrinsic value growth. And Westpac sits in between all of them.
What about a company like Bank of Queensland? Have you done an assessment on them? Because they've done well over the last 3 or 4 months in particular.
Peter, generally when we think about price, when we think about businesses, we think about pricing power and which businesses have the best pricing power or the highest switching costs or who's got the best competitive advantage. And because of the oligopolistic nature of our banking system and the market share that they have, there's really no need to look outside of the big 4 banks.
Okay, all right. So have you got a view on Rio? Is Rio more vulnerable than BHP because it is nearly all iron ore?
So our ranking, when we rank the big resource companies, BHP has the best quality balance sheet and the best return on equity. Rio has a lower quality balance sheet, although they're rectifying that by getting the debt down, but it's a lower quality balance sheet. They've made some lower quality investment decisions in the past. And then you've got Fortescue, which has the highest leverage to the iron ore price. So if the iron ore price drops, it's going to fall the most. Now, do I think my scenario, as I've described, is going to play out? Yes, I do. Otherwise, I would think about owning mining services businesses, and probably not mining businesses, but mining services businesses. In the mining services space, we sold our mining services companies en masse in April last year, so a year ago. And our big concern about this space, and it's important everyone understands it, they've got great quality balance sheets, no doubt about that.
Modelf is a classic case.
Their performance to date has been extraordinary. But what we can't get our head around is the future. And we're very, very concerned that there's been a proliferation of listed mining services businesses that are now servicing a contracting pool of jobs. And when those jobs drop, and you've seen it in the ABS stats, so capital expenditure is now falling in the resource space and the materials space. And what's actually happening is you're going to have more companies bidding for fewer tenders. So clearly there's going to be more competition. The price that they bid will be lower. So the companies that win the jobs will have lower margins, and those that don't get the jobs may just go out of business.
Okay, so the pivotal thing really on a lot of your analysis will ultimately be the strength of the Chinese economy and what it does to commodity prices.
Exactly.
Okay. So it's good to know what we'll be testing Roger Montgomery on over the next 6 months or so. All right, buddy. Thanks for joining us on the program.